Welcome to the Other Side of Wall Street with your host, Ron Harrison.
Good morning, everybody. Welcome to the Other Side of Wall Street. I want to welcome you all back, those who joined us last week for our first episode, and hopefully any new listeners, welcome. Each week we're going to try to train and educate you, and I personally will try to take you on a journey that I myself took years ago as I started my career trading on Wall Street, back around 1990. And the point being is that I want to share with you exactly what I discovered working on the inside and just looking at just how different the two scenarios are, and those two scenarios being how the brokerage firms want you to trade your money as a retail investor and how they trade their own money, which you're going to find out is very, very different. So where we left off last week, I had joined a firm, large Bear Stearns, got hired into the options department. And before you can start working, before you can start actually trading, they put you through a class teaching you how to trade the way they want to have you trade their money. You just can't sit down and start doing what you want. There's a very specific method that they want you to use. And of course, that method produces results. And that's what the name of the game is results, money. And one of the interesting things was that prior to that, I had been, as you know from last week's show, I had been a broker. I had been pushing junk onto people. Like I said last week, I would cold call and I would call up people I don't know, try to convince them to buy things they didn't want, and actually things they shouldn't want. So I got a very good look at the retail side about just how the brokerage firms try to stack the odds against. Not try, they actually succeed, stacking the odds against the retail investor. Had enough of that, watched that for a couple of years, couldn't do it anymore. So now I had managed to secure a job inside a firm, trading the firm's money. And one of the first things that I noticed as I was watching, and that's kind of like one of the things that I like to do. I like to sit back and I like to watch. And in this case, in the world of investments, in the world of Wall Street, whatever you want to call it, I always felt that a good thing to do was watch the money. Watch where the money flows. Watch where it comes from. Watch where it goes to. Watch what's going on to entice people to take their money and go into this investment or that investment, and how the whole machine works. Kind of like if you were hovering in a helicopter over a freeway and you're just watching all the traffic jams and you're watching all the cars moving and you're watching everything that's going on. That's kind of like what I wanted to do and did do while I was there. And it was very enlightening, very eye-opening, just how different the two worlds were, which I just mentioned was the retail side, how the brokers enticed the customers to trade, invest their own money, and then how the firms themselves trade for themselves. And it's two totally separate worlds, and they also happen to produce two totally separate results, which are not very good for the retail investor and extremely good for the brokerage firms. So anyway, as I'm watching all this, I start to see how all these pieces fit together. And for instance, one of the things that I noticed is that like on CNBC, Wall Street Journal, any of the magazines, newspapers, there's always people talking heads, they like to call them, analysts coming on, giving their opinion of this stock, that stock, the market in general, what's going here, what's going there, what's going to go up, what might not go up, what's going to go down, so on and so forth. And I learned very early that in this world, and actually in any case, but it really applies heavily here, is that I guarantee you nobody, and I mean nobody, knows where any stock or any market is going to be tomorrow or even an hour from now. It's possible. No one knows. So you have all these people coming on saying, yes, this stock's going to go up. You better get in now before it's too late, blah, blah, blah. Or it's going to go down, get out before it's too late. Or given their forecasts, their projections, so on and so forth, about where any particular thing is going to go. Trying, and the purpose behind this again, is trying to give the public enough information that they will decide to part with their money and put it in whatever investment they are touting, that they are pushing. Now, again, that was the same thing we were doing at the brokerage firms as a broker. We were telling our customers whatever we had to tell them to get them to part with their money and purchase the thing that we were selling, whatever stock that was. Well, the people that you hear, the media, let's just generalize it as the media, is no different. The media is filling the retail investors' heads with their opinions of where something is going to go for the sole purpose of getting the retail investor to part with their money and buy this thing that they are pushing, whatever that could be. It could be a stock, it could be a fund, it could be index funds, it could be futures, it could be currencies, it could be anything. But that was one of the things that I noticed was going on big time. And of course, since I'd already lived in the retail side, it was easy to kind of identify this. But one thing that you have to keep in mind is that, this is something else I also noticed at the time, was that all of these things, these efforts that they're putting into putting information out there, so the retail investor will cough up the money and actually purchase something, is directional trading. From the retail side of this business, you are every day, either through brokers, through analysts, through whatever, are enticed to put your money down and buy something. Buy a stock, buy a fund, buy some currency, buy a futures contract, buy something. And one thing that you can be 100% sure of is that any of these things that they're trying to sell you can only do one out of three things. Or will do one out of three things. Go up, go down, or stay flat. That's the only three directions they can go: up, flat, or down. So if you buy something, if you listen to what they're saying, your broker, the analyst, whoever you're listening to, however you're getting your information, and you wake up that morning and say, okay, I've got to have me some of XYZ stock. I can't wait any longer. I've listened to enough. I've got to have it. And you go online or call your broker, however you do it, and say, I need X number of shares of this stock. Now, buy it for me. Because of what they've heard, because of the analyst's recommendations, whatever the reason, they have to have it. If you buy that stock, if you buy that thing, you have a 1 out of 3 chance of making money right off the bat. Because like I said, things can go up, stay flat, or go down. But if you buy, as soon as you buy, you're limiting yourself to profiting only if that vehicle, that thing, goes up in price. If it stays flat, you don't do anything, you don't make any, you don't lose any. If it goes down, you lose. So what kind of let's just say you're starting out right out of the chute with very bad odds, 1 out of 3 chance of making money, or 2 out of 3 chance of not making or losing money. So that is not a very sensible, to me, way of investing. But that's what the retail public does day in and day out. And that is one of the reasons, there are many more, but that's one of the reasons why most retail investors lose money. Because they are placing a bet on something that has to move in one direction and one direction only so they make money. And it doesn't, most of the time, work out that way. But now that I'm in the firm and I'm seeing and I'm working for the firm, trading the firm's money, one very important factor is becoming very evident to me once I've made it through the class and learned how they want me to trade, is that the firms, with at every opportunity they can, they don't trade directionally. They trade non-directionally. So what they do is they place trades on stocks, on indexes, on the market in general, whatever you're doing, they like to place trades that are non-directional. In other words, their trades will make money if the market goes up, if the market stays flat, or if the market goes down. And actually, in many cases, and in most cases, flat is actually the most profitable of the 3 directions. If it doesn't do anything, that's best for them. And by the way, I should also point out that the department that the department I was in was options. So that's what we were dealing with, options. And it was very, very eye-opening to me to see that one side of the business is trying to convince the retail investor to put money into something very directional, 1 out of 3 chance of making money, while at the same time the firms themselves are putting themselves in positions that have almost a 3 out of 3 chance of winning. So odds are very different from one side of the fence to the other. And it was a very eye-opening, light bulb going off kind of moment for me, that wow, no wonder the firms make the kind of money they do, and no wonder the retail investor tends to lose as much as they do, because they are in directional trades. And like I said, regardless of who's talking, regardless of who's writing the article, no one knows where anything is going to be tomorrow. No one. So how can you put your money on something that you really can't predict? And they do, and more times than not, they lose money. So that was one of the first things that I happened to really notice when I was there. Now, I looked up a year or so ago. I remember I looked up some stats, and what I found was that the brokerage industry spends billions of dollars a year. I don't remember the exact numbers, but I know it was in the billions of dollars a year on market research in order to, and most of that is done by, what I mean by that is they will spend a fortune putting their analysts out there, creating hype for the market, the stocks, the industries, whatever. So they spend billions of dollars every year on market research to pump that out to the public in order to fill the retail investors' heads with massive amounts of information. In other words, this is going here, this is going there, this is going to do this is going to do that, and so on. At the same time, the brokerage industry only spent low millions of dollars on educating the retail investor on proper ways to trade. So they're spending very little on education and great amounts on hype, let's say. And what they're doing is, and they're no dummies, what they're doing is they are putting a lot of effort into playing off of the psychological mind of the retail investor. They know that the more information that they can plant in a retail investor's mind or head, the more likely they are to go out and purchase or buy or do something. So what they're trying to do, that's kind of the fuel for this whole machine. The retail investor has to be convinced to part with their money to buy whatever the brokerage houses are selling. And to do that is done by hype, by information, by the media, by planting enough information in the retail investor's head that they will do what the brokerage house wants them to do. And it shouldn't be that way. And another thing that they do is, I've noticed over the years, is that like the E-Trades and TD Ameritrades and all the online brokers, their charting information, their charting platforms are getting more and more and more sophisticated, which can be a good thing. It could be a bad thing. In this case, I think it's more of a bad thing, because since they're not really spending any time educating the retail investor. But what I found is that with these charting packages, they have piled on so many indicators, technical indicators that they can put on the chart. And in almost every case, if you're a beginning investor and you start piling on a lot of indicators that you don't truly understand, basically what you're going to do is clutter your chart up with indicators. But more importantly, what you're going to end up doing is you put enough indicators on a chart, and trust me, you can make that chart say anything you want it to say. So if you take the information that the retail investor is taking from the media and you combine that with lack of technical skills and overly cluttered charts, that information that's in their heads, they will figure out a way to make that chart confirm what they've heard in the media and what now they already think that they know about this particular stock or whatever. And that is a recipe also for disaster. And we're coming up on our first break. Let's take a break and we'll be right back.
Here's another look into the world of trading.
I have a question. How many of you think you can predict the future? Did you know that you're trying to do just that when you purchase a stock? When you own a stock, the only way you can profit is for the stock to increase in value. And if it trades flat or trades down, you end up losing. What if I told you that there is a much better way to profit without ever owning that stock? And what if I told you that you could take a position in that same stock and profit no matter what the stock does? That's right, you can profit if the stock goes up, trades flat, or goes down. No matter what, you profit. This is how the pros trade, and this is how you should be trading. We are the other side of Wall Street, and we would love to teach you how to trade like the pros, increasing your odds from 1 out of 3 to almost 3 out of 3 on every trade you place. Interested? Call us at the other side of Wall Street at 949-734-1698 and sign up for one of our courses. And again, that's 949-734-1698. Now let's make some money. We're back, the other side of Wall Street, and we've been talking about how the brokerage industry uses the media to influence the minds of the retail investor to convince them to do what it is that they would like them to do as far as buying something. Now, what I want to maybe back up a bit and go back to where I was actually inside the firm, and that is the options department. So options, as I'm sure many of you know, have a very extremely bad reputation. If you tell somebody that you're going to trade options, most likely you're going to get some kind of bad face and, oh God, don't do that. Everybody I know that's traded options loses everything. You lose your house if you just all kind of horror stories about the bad rep that options have in the market. And it's true. I think probably high 90% of all money spent buying options is lost. And that's not by mistake. That's by design. Now, let's back up a bit and look at really why options are here to begin with. So if you go back far enough, and again, you got to keep in mind that the brokerage industries are very smart. They are constantly playing on the emotions of the retail customer. So they spend a fortune trying to figure out how to capitalize on emotions, specifically the emotions of the trader, the retail investor. So originally there were no options, but what the brokerage firms realized is that there were two very distinct types of people out there in the marketplace that are buying, trading, investing, whatever you want to call it. You have the long-term investor, the ones that don't mind shelling out whatever it costs to buy a good stock, a good company, or even a bad company, whatever the case may be, but a company. And they will pay the price, they will buy the stock, they will hold it, they will cross their fingers, hope that it goes up, all the things that the typical investor is used to doing or thinks they should do. So those are one type of investor, the ones that don't mind putting out the money, buying the stock, and sitting on it, crossing their fingers. But it didn't take them long to realize that there's another type of person out there that has money. And that type of person is a gambler, the kind of person that would go to a racetrack, or the kind of person that would go to Vegas, or anything that involves putting down a little bit of money for the chance, however slight that chance is, of making it big, of winning big. So spend a little in the hopes of winning big, just like you do when you pull the lever on a slot machine in Vegas. So they said, how can we entice those people into the market? There's another whole group of people out there that has money burning a hole in their pocket. They want to spend it, but they don't want to put up enough to buy, shares of outright stock, but they want to gamble. Hence, options. So now the brokerage industry introduces options to the public to where now you can come in and for a little bit of money, you can buy an option that represents the equivalent of actually owning the stock as far as, well, actually, I shouldn't even say that. It's not the equivalent, but the investor thinks it is. But now you own this option that if the stock goes up, you stand to make some money. Not as much as you would make if you outright own the stock, but nonetheless, you spend a little, hope the thing moves up, that is a stock, and hope to make some money. Notice that word hope is in there a lot. The funny thing about options versus owning the stock, if you own the stock, you can own it forever. It can go up and go down. It can go down to almost worthless, but you can still own it. Nothing's going to change that unless you decide to. If you own the option is going to expire on a certain date down the road, like a month down the road. It's going to expire, go away. So again, back to what we talked about earlier, directional trading, that word buy, if you buy the option in this case, you still have that same 1 in 3 chance of winning, just like when you bought the stock. In order for you to make money, the stock has to go up. 1 out of 3 up, flat, down, but it has to do that one thing, which in this case is the up direction. Now with the option, same thing. It has to move up for you to make money, but now you're working against the clock because now this thing is going to expire weeks down the road and go away. So if your stock has not moved up, the stock that option is representing, if it has not moved up in the time that you have before expiration on that option, the option expires and you lose all your money. So that is why options have such a bad reputation. A high 90% chance of losing money, which is research has proven that. So again, the brokerage industry has figured out a way to capitalize on the gamblers out there and get their money. Now think of it this way. Remember we talked last week about the market being a zero-sum game. Money doesn't disappear, it doesn't go away, it just transfers from one to the other. And what I learned working there was that, again, watching the flow of money, is that the money almost always tends to flow from the inexperienced, from the novice, from the amateur, the retail investor, to the professionals, to the ones that know how everything works, and the ones that are controlling the media. It flows from the inexperienced to the knowledgeable. And that is how Wall Street makes its money, and that is how it works. So think of this also. You have a vehicle now that has a high 90% chance of failing for the retail customer. So being that the market is a zero-sum game, if you have an instrument that has a high 90% chance of failing for the retail investor, who's got the other side of that? That means if one side has a 90% chance of failing, the opposite side has to have the same 90% chance of, except in this case, winning. You can't have a 90% failure rate on one side and not have the same 90% success rate on the opposite side. And in this case, back then, the opposite side was the brokerage industry, the brokerage firms. So the apartment I was in, we were selling options daily to those inexperienced gambling investors, people that wanted to put a little bit down for the chance of making something off of very little investment. But they weren't. The options were expiring. They were losing their money. Guess who was on the other side? You guessed it. It was the brokerage firm or the house, however you want to look at it. So again, this whole thing pretty much mirrored Las Vegas. So in Las Vegas, you come in, you put a few little bit of change in the slot machine, you put a little bit down on the table, hope to win big. You don't. The house rakes it in. Off you go, disheartened, disenchanted, whatever. Head between your tail. You're ashamed. You're stupid. You feel like you're stupid. You walk out. Why did I do that? All I did was lose my money. Well, the brokerage industry is no different. The brokerage industry is enticing the amateur, the unknowledgeable public in with vehicles that are designed to fail. And again, based on the zero-sum game, the public loses, the firms make the money. The money has to go somewhere. So that's what I was doing in that department. And again, if the picture or the point you have to get from all of this is that the brokerage houses, the brokerage industry is very smart. They spend a great deal of money analyzing how the investor, the retail investor, how they think, how their mind works, why they do what they do. And that is basically the basis of one of the most important things that I learned in trading via many different avenues is trading psychology and how massively important that is to the success of a retail investor. How your mind thinks, how your emotions work, your fear. Actually, there's three components: fear, greed, and ego. And those three things basically is what will drive you to success. But the sad part is, in most cases, it drives the retail investor to failure. And I would venture to say that if you look at it and do enough research, you will, even on your own trading, and think and look deep enough, you will find that every failure you have had trading has been a direct result of either the emotion of fear, the emotion of greed, or the emotion of ego. One of those three has, I would almost guarantee you, has caused every failure you have had to occur. And the brokerage industry knows that that is the case. So they spend a fortune trying to capitalize on the knowledge that they have that the retail investor is going to trade off of fear, greed, and ego. And believe me, they exploit that to the fullest. And now we're starting to get near the end of our show today, so I kind of want to wrap this up. And we're kind of starting to focus more on trading psychology. And as you become a better trader, you need to realize that there are going to be three basic categories of trading psychology that you have to deal with as a trader. First being your own fear, greed, and ego. Secondly, being the other side of the deal, the other side of the trade. In other words, your customer, let's say, their emotional makeup, their fear, greed, and ego, and how they're going to respond to the trade you're putting on. And lastly, third, is the mass market emotions, again, fear, greed, and ego, but how the market is acting as a whole. So it's those three things that you're going to have to deal with, and it's those same three things that we're going to start touching on pretty heavily in future episodes. So stay tuned for that. So with that being said, I would like to invite you, if you'd like to find out more about what we do and about what we talk about here on the show, I would love to have you visit our website. That is theothersideofwallstreet.org, theothersideofwallstreet.org. And in more particular, in the if you're thinking about trading psychology, there we have blogs there. I think our last blog was specifically dealing with trading psychology, so you might want to read that. I think it's called Why So Many Traders Fail. So it's on the website, available for your reading. Otherwise, there's a lot of good things there. You might want to think about signing up to become part of our trading tribe, where you will be able to attend our weekly webinars, to where we go into an hour a week and much more depth, all the stuff we talk about here in the show. But it's much more involved than what we get in this half hour here, and it's weekly, 1 hour a week, plus a lot of other good stuff when you become a member of our tribe. One of them in particular is that you will also receive instant updates on all of the trades that we place for ourselves, when we open a trade, when we adjust the trade, and when we close the trade. And that could be pretty valuable. And other than that, I just want to say thank you for joining us today. Hope you've gotten something out of this show. And in future episodes, we will continue to expand on the same topics, especially the trading psychology. And eventually, we're going to get into technical analysis, how to construct trades, all the good, fun, technical stuff that I'm sure you're chomping at the bit to get. We'll get into those in good time. Again, like we said last week, first thing that we have to do is lay the foundation. And that's what we're trying to do with these early episodes. And then once we get past that, we will at that point be off to the, let's say, the more technical aspects of trading and actually how to make money, which is what this whole thing's about. So that's it, I guess, for today. Again, check out our website. Lots of good stuff there, theothersideofwallstreet.org. And well, other than that, we'll be back. We'll see you next week. Thank you. Bye.